Hey, it's Tom here and welcome back to the channel. So this week I have been involved in a couple of different podcast episodes, kind of away from the main YouTube channel here. One of those is actually my own podcast, the Investing with Tom podcast. This week I got the chance to interview author William Green, the author of the new book just this year, Richer, Wiser, Happier, and that episode is now live. So if you're interested in checking that out, that will be linked down in the description below. Thank you to everyone who has listened to that so far. It's been pretty well received overall, so appreciate all the kind words and a few of the messages and things that I've got around that episode. And William, if you happen to be watching, big shout out to you for taking the time to record that episode. It was great fun. So that is the first one. The second one, and kind of the topic of this video, is actually another podcast I was on based here in New Zealand, which was the NZ Everyday Investor, and I was kind of a guest on one of the weekly kind of shows that they have on that podcast, which is News of the Money Week. And the topic of this particular episode was kind of twofold. Firstly, it was like an introduction to value investing, hence kind of my involvement, I suppose. And secondly, it was about kind of how to invest in a hot market, and is there a way that we can apply value investing sort of principles to that particular discussion. So I want to share some highlights from that particular podcast episode in this video, and maybe give you some further thoughts on it after kind of reflecting on that episode a little bit. And I will also leave that full podcast, both an audio and a video version, linked down in the description below if you're keen to check that out. And I always enjoy doing these types of podcasts because it allows me in a lot of ways to kind of get back to first principles and back to basics. I think sometimes I'm a little guilty of getting too far in the weeds with certain kind of advanced value investing principles and that sort of stuff. So it's kind of nice to pull back a little bit and introduce the topic from kind of the beginning. So firstly, I just want to talk through kind of how I actually view and define value investing, because I find that a lot of different value investors kind of have different philosophies and different approaches in terms of how they invest in the stock market, and I want to just very quickly kind of share mine if you're not familiar with it already. So the way I view value investing is simply just trying to buy something for less than it's worth. I'm fairly agnostic when it comes to buying into big companies or small companies or companies across different industries. I will value companies that grow really fast or that grow maybe a little slower. I will value companies based on their cash flows or based on their assets. I'm kind of very agnostic to the way that I approach that. And I think it is really important to be open-minded in that way. I mean, if we go all the way back to the 1920s and 30s, when Ben Graham, the Dean of Value Investing, a professor at Columbia University, first was kind of coming up with these value investing principles, he had a lot of actually quite kind of set rules. Like he would sell out of a stock once it had gone up 50%, or if the stock didn't perform for a certain period of time, he would sell out of it as well. And I think those rules don't necessarily fit all investment cases. What Warren Buffett found is that if you can buy one or two great companies and hold them for a long period of time, there's really no reason to sell them if they continue to compound. And it's also important to understand the different things that drive particular companies, because there are really quite different ways that you can value different types of companies as well. Back in Ben Graham's day, he was often valuing companies on sort of a liquidation value type basis. So if you bought all the shares in the entire company and just wound the thing up and sold all its assets at kind of fire sale prices, what would the business be worth in that kind of liquidation scenario? And that was really just kind of a result of just how cheap markets were at that time. But in the modern age, we really have a lot of businesses with actually very few assets. You know, if you think about the Googles or the Facebooks or the Apples of the world, that really have intellectual property and code oftentimes as kind of the things that they can use in their business to produce cash. Liquidation value type scenarios really don't apply very well to those types of businesses. And that led us to a discussion on a business like Facebook more specifically. So if you are a really hardcore traditional value investor, you will pretty much immediately just turn your mind off to a business like Facebook. They don't have a lot of physical assets. You can't buy it at a discount to its book value or anything like that. But book value in the case of Facebook is really irrelevant. And we've actually seen quite a number of value investors, probably Bill Miller being the one that springs to mind immediately for me, invest in a business like Facebook and make good money out of it over time. And the reason that Facebook can be sort of a value investment is that we're not necessarily always trying to buy things at a discount to liquidation value. We're just trying to buy them at a discount to their value more generally. And if we think that the growth and the cash flows that a business like Facebook will produce over time more than justify the price that we're paying up front to buy into that business as a shareholder, then that can be a very successful investment over time. It can provide you the margin of safety that you're after as a value investor and the downside protection that you're really hunting for, and it can also provide really good upside over the long term. Now, the next part of the discussion with Rupert and Darcy on this particular episode was actually around kind of broader market valuations and, how do we approach investing in hot markets? Are we in a bubble? Is this whole thing going to burst and just explode? And if you've watched basically any video ever about investing, you'll know that anyone that tries to predict that kind of stuff is pretty much always going to get it wrong. A broken clock is right twice a day. So, from time to time, people do predict these things and it looks like they have superpowers and predicting financial markets and so on, but to a large extent that is really not the case. But nonetheless, it is interesting to kind of go back and forth a little bit and try to better understand where things are sitting, particularly from a valuation perspective, which I like to focus on, relative to where those valuations have been more historically. And there's no question that the stock market has run up a lot recently. And it's not just the stock market, it's the real estate market. Even commodity prices are through the roof right now relative to where they've been historically. And the question really is kind of, where do things go from here? Are we completely stretched out and there's just no way things can possibly go further? And this is sort of my view on the whole thing. And of course, I don't really let broader market valuations and so on influence my individual business, selections and my individual business investments. But nonetheless, these are kind of my thoughts on that particular topic. So if we compare where current market prices sit relative to the tech bubble, I think that's actually quite an interesting kind of reference point. So you can look at simple price metrics on something like the S&P 500 in the US, say a PE ratio, for example, or a Wilshire GDP ratio or a Schiller PE, and you can say, things are really, really stretched. But you have to understand that the timeframes that you're comparing against in the past, where valuations look lower on those metrics, were quite different. And the main way in which they were very different is interest rates. Now, as an investor in anything financial, really, you're pretty much always basically comparing the different opportunities that you have available. And one kind of historic benchmark that everything sort of gets pinned against is the risk-free rate. So the 10-year treasury bill from the US government that you can invest in, collect interest. The US can't default on those T-bills because they can just print more money if they need to. And that's kind of viewed as the lowest risk investment where typically you're getting the lowest return as well. So if we go back to the tech bubble in 1999 and 2000, this is kind of where things stood with interest rates and also with market prices. So at the time, you could actually get quite good interest rates just on a 10-year T-bill, the risk-free rate. So that was actually sitting at about 6% in 2000. Now, if you compare that 6% sort of yield to what you can get in the stock market at the time, the numbers actually are really interesting. So typically when you invest in the stock market and you invest in, quote, risk assets, generally you'd think you would get paid a premium kind of over and above that 6%. But this is where things stood for the S&P 500 at the time. So at the time, the market was trading at about 45 times earnings. That's the peak that it kind of got to in the dot-com bubble. Now, one of the things you can do with a P ratio is you can invert it. So if we flip that P ratio over and go 1 divided by 45, that gives us about a 2.2% earnings yield on the index. Or in other words, if you view yourself as a true owner of the businesses in the stock market, then what you should expect to earn from those underlying businesses is about 2.2%. And the great thing about investing in businesses is that businesses tend to grow as a whole over time. So unlike investing in a T-bill where you're getting your 6% and it's just kind of 6% forever, you can get your 2.2% in the S&P 500, and that 2.2% might grow over time. So it might become 2.2% 2.5 and 2.7 and 3% kind of if you're a long-term owner of those businesses. But nonetheless, those yields really are quite backwards. Even though you are getting growth in the underlying businesses in the S&P over time, you should still be getting a premium to that 6% that you can get in bonds risk-free. So, obviously it was a bubble in hindsight. These things are really, really difficult to see when you're kind of working through them at the time. But it's kind of an obvious bubble, and it's a key point in history that we look back on today. Now, if we compare that situation to what it looks like today, it's actually a really interesting comparison to do. So interest rates with a 10-year T-bill are much, much lower than they were in 2000. If you were to put all your money in T-bills, you would earn about 1.5% today. One thing I haven't factored into these numbers at all yet is inflation, but inflation is running far north of 1.5% a year right now. So in real sort of purchasing power terms, if you were to put all your money in those bonds, you would actually be going backwards in terms of what you can buy with your money, but that's a discussion for another video. So with bonds in 2021, as of filming this video, you can get 1.5%. The PE ratio on the S&P 500 right now is about 34. So again, if we invert that 34, just like we did with the tech bubble example, 1 over 34 is about a 2.9% yield on the index. So when you put it in those terms, yes, 2.9% is not a large number, but it is quite good compared to the 1.5% you're getting in bonds. And this is really the main argument I think a lot of people have for saying that there's basically no alternative. And a lot of the people that say the stock market is overvalued and it's going to crash, in many ways, people will argue a kind of fear-mongering because unless interest rates go up, and that is kind of the multi-trillion-dollar question you can ask here, then the stock market really doesn't look that expensive relative to current interest rates. Now, if interest rates were to go up to 3 or 4 or 5 or 6% again, then suddenly things look very, very expensive. Still not to the level of the tech bubble on that comparison. You were getting a 2.2% earnings yield in the tech bubble versus about 2.9% today, but nonetheless, it would make things look very stretched very, very quickly. And all of this stuff is really, really hard to predict in terms of what's going to happen in the future. I saw a quote the other day, and I'm going to butcher it, so I'll put it up on the screen here. And the quote goes something like, macroeconomics gives you the opportunity to be wrong on really large things in the economy, and microeconomics gives you the opportunity to be wrong about more specifics. I'm sure I've just butchered that quote, but you'll see the real deal on the screen here. And although that's kind of true, I really do think microeconomics, or studying the economics of individual businesses, is often much, much more straightforward than trying to factor in like a million different variables with global macroeconomics. I really don't think there's anyone that can do that particularly well, if I'm being honest. And that's the reason why I tend to focus on individual companies. And I like to value individual companies and try to buy them with a sufficient margin of safety to protect my principal. My hard-earned money that I've sacrificed my time to kind of bring in the door, I don't want to give that away and lose it. I want to earn a reasonable return on it without taking crazy amounts of risk. So that's it from me for this video. If you want to check out either of the podcasts that I mentioned in this video, they will all be linked down in the description below. And I'd also be keen to get your thoughts on this whole discussion of individual companies versus trying to predict what the broader market's going to do and all that sort of stuff. Interested to hear that down in the comments below if you're keen to share your view there as well. But that's it from me for this video, and I will see you in the next one. Cheers.